I want to start trading, but I don't know what to buy. Sound familiar? Well, it should do, because that's a question almost every single new trader will ask themselves. The first step in deciding what to buy is understanding the choice of markets you can trade. So in this video, I'm going to go through the different types of markets, how they work, and offer some clues to help you decide which ones you'd want to trade. Hi guys, it's Jasper, market analyst for WeTrade and founder of Trading Writers. Let's kick things off with what I think is a handy little rule of thumb. Now remember this, even rewind the video if you have to. Trade fewer markets frequently or trade many markets infrequently. I learned this lesson in my early days of trading. Embarrassingly, we're talking like 18 years ago at this point. The reason for this is quite simple. If you are regularly in and out of trades, you need to focus on the markets you're actively trading. Equally, if you're trading less often and holding on to your trades for longer, you have the time to follow multiple markets to find enough opportunities to make the whole thing worthwhile. I mentioned this rule of thumb because when I go through the various market types in this video, you might decide to focus on only one market or trade all of them. It's really up to you. Forex, or FX as it is sometimes known, is the largest market in the world. Every day, around $5 trillion worth of currencies change hands across global markets. This is where I got started trading, and it's still one of my favorites, but each to their own. Forex is traded 24 hours a day, from Monday morning in Australia through to Friday evening in New York. The trading day is split into three, the Asian, European, and American sessions. The fantastic thing about these long trading hours is it gives you a lot of flexibility over how to go about your trading. Where are you in the world? If you have a job, what hours do you work? You can customize your Forex trading to match the time you're available. The way you trade Forex is in pairs. That means two currencies at once. You are using one currency to buy another one. For example, if you were to take a position in the euro-dollar pair, you are trading the value of the euro against the dollar. Breaking this down a bit further, if the price of euro-dollar is 1.10, then it means every euro is worth $1.1. If you buy euro-dollar, you are trading on the expectation that the euro will rise in value relative to the dollar. If you sell euro-dollar, you are expecting the euro to fall in value versus the dollar. The more the currency pair you have traded moves in the direction of your trade, the more profit you can earn. Likewise, the further the currency pair moves in the opposite direction to your trade, the more you stand to lose. The most popular currency pairs to trade are known as the majors. That's euro-dollar, dollar-yen, pound-dollar, dollar-Swiss, and Aussie-dollar and dollar-CAD. Phew, that was a mouthful. You will notice that they all trade against the dollar. If a major currency is paired with another major currency, which is not the US dollar, it's called a cross-currency pair. Now, I bet a question has arisen for some of you. How can I buy a currency pair when I don't own either one of those currencies? For example, say you're in the UK and your account's in British pounds, but you want to trade the euro against the dollar. Well, thanks to the computing power of the trading platform, it's all calculated for you in real time so that any profits or losses are all converted back to the currency your account is denominated in, which in this case would have been British pounds. Okay, next, shares. This is really what everybody immediately thinks of when it comes to investing and trading. Things have moved on from the days of busy traders making hand gestures on the trading floor. These days, almost all share trading is done electronically. As a quick explainer, when a company wants to raise money to invest into its business, it basically has two options. It can borrow the money or sell a share of the company to investors. Traders will then trade these shares on a secondary market, which is normally a stock exchange. Probably the biggest reason for the popularity of trading ordinary shares, it is quite easy to understand why prices move. If a company is doing well, its shares are likely to rise. If a company is doing badly, its shares are likely to fall. Traditionally, traders tend to want to buy shares because they believe a company is going to do better in the future, and they believe the share price will rise to reflect the performance of the company. It's also possible to sell shares short, meaning you borrow the shares and sell them, hoping to buy them back at a cheaper price if the company starts to underperform. A popular way to trade shares is by following their earnings. Top US companies like Apple and Facebook release earnings every quarter, giving traders a regular update on changes to their profit and sales. When earnings are high, but the price is relatively low, shares are said to be undervalued. Conversely, when the price is high, but the earnings are low, the shares are considered overvalued. If you think you might have a knack for picking stocks, look no further. By the way, if you're getting some value from this video, please just tap that little thumbs up button down there. Really appreciate it. The market is up 500 points today. We've all heard a TD presenter say something along those lines, but what's less clear is that they're normally talking about a stock index. And a small grammatical point is that if we're talking about more than one index, we say indices. So specifically, an index is a portfolio of shares that represent a particular market. The most common market an index will represent is the top shares listed in a certain country. For example, the FTSE 100, which features the top 100 companies on the London Stock Exchange, or the S&P 500, which is the top 500 companies listed on the New York Stock Exchange and the Nasdaq. The price of all the shares in the index, often weighted according to the size of the companies, are averaged to give one single price for the index. If an index price rises, it can be assumed that the market it represents is performing well, whereas if an index falls in price, then the market is likely performing poorly. Rather than just a few specific company shares, indices could be the market for you. Trading in commodities is one of the oldest businesses out there, easily predating modern markets. Commodities are also a very easy thing for new traders to get their head around. That's because everybody knows what a lump of gold looks like. Though clearly we don't trade gold in lumps, we trade it in ounces. So the price of gold is usually quoted per ounce. Thanks again to the marvel of technology, traders can buy gold, sell it a few hours later, and never have to actually take delivery and store the stuff, which makes life a lot easier and cheaper. Commodities are typically split into four main categories: metals, energies, agricultural, and livestock. Metals include gold, silver, and copper. Energy includes crude oil, heating oil, natural gas. Livestock includes hogs, pork belly, and live cattle. And agriculture includes things like corn, sugar, and coffee. Precious metals like gold are often used as haven investments in times of high market volatility and economic uncertainty as a store of wealth. Basic supply and demand principles tend to drive most commodity markets, so low supply and high demand usually drive prices up, whilst high supply and low demand have the reverse effect. If you want to trade gold in the expectation of the next market panic, or you just like the purity of trading a real material, you might be suited to trading commodities. Now you might be thinking we're missing a market here, crypto. Yes, don't worry, that's coming in a future video. Thanks for watching, and don't forget to like and subscribe to the channel, and happy trading.